Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Jack Miller, Global Head of Execution Services over at Baird. We're going to take a look at the SEC market structure proposals and what it means for retail and institutional investors alike. It is great to see you as always. Welcome back to New York and MarketSite.
Great to be here, Jill. Thank you.
We're a couple months into the year in 2023. It's kind of been a marathon already. Yes. How has the year started out for you? What's on top of mind for clients?
Yeah, well, just as we were just discussing just now, I mean, it's a lot of uncertainty out there right now. And even though the markets are up for the year, we're coming off a tough February. Still a lot of lingering concern about inflation, the actions of the Fed. We have the Powell testimony going on. And until we get some clarity there, it's going to continue to be a really uncertain environment. On the execution side, the challenges remain the same. I mean, it's still a challenging environment to navigate the market structure, find liquidity for clients, and then of course in the background we have these SEC proposals that we've all been digesting for the last couple of months.
So speaking of that and the folks that you're speaking with, are there any common themes in terms of the industry reaction to the SEC proposals?
Yeah, so we were sitting here a couple of months ago and wondering what the actual action of the SEC was going to be. And I think, obviously we had the proposals released in December. Thematically, not a bunch of surprises there. Chair Gensler was very open about telegraphing what the agenda was likely to be. I think the main surprise, though, is just the level of specificity, the level of prescriptiveness, and then the breadth of the proposals, which was a surprise to some market participants and a little bit unusual in terms of the regular pace of rulemaking. I think, though, thematically, they do attack some well-supported goals. It's just one of these things where the devil is in the details in terms of the the implementation. And they vary in terms of controversy. You have something like the Best Ex disclosure rules, i.e. the update to Rule 605, not particularly controversial, but then something like the order competition rule, which is very controversial, and it gets right at the core of the market structure for retail investing in particular.
It's interesting because a common theme seems to be improving the market structure for retail. And I'm not quite sure retail investors think about this every day. So
Sure.
Is there going to be any impact for retail clients? Are you hearing any concerns?
Yeah, well, there's certainly been impact, but if the question too, is this something that we're hearing a lot of questions about from our retail clients? The short answer is no. I think generally what our clients are interested in is to have a reasonably certain execution, reasonably immediately, at a price that is related to what they see on their screen, whether it's the internet or a FACSA terminal or what have you. So, and in general, that's what they get. So when we're talking about retail market structure and the ability to improve, we're really talking about pricing within the spread. And in general, that's not something that most retail investors are directly focused on. And I think if we kind of look at certainly there's an opportunity to improve, but I think looking at these proposals, it's worth looking at the cost benefit. So on the benefit side, there's certainly an opportunity, and I think the SEC's own data show that there is liquidity inside the spread that's not necessarily being interacted with. But a reasonable upper bound on the benefit that we could see from that is a half spread. And if we're talking about the names that our retail clients are most active in, spreads are already as narrow as about 7 basis points on average. So, an upper bound would be half of that. And the SEC's own data, quantifies the benefit as a little over a basis point. So a little over 1/100th of 1% in terms of the potential benefit. And on the cost side, of course, there's risks that this actually erodes the other aspects of the investing experience, i.e. that immediacy, that certainty. Certainly a 100 millisecond auction is not what's going to create a delay, but you have markets potentially moving during that auction, you have potential signaling, you have potential negative selection around that might actually erode that experience, and that's something that I'm a little concerned about.
What about institutional investors? It doesn't seem to be as if the proposals are necessarily focused on that.
Yeah, not as directly focused. The language of the proposals is certainly oriented around retail, but insofar as our markets are interconnected and market participants are all interacting with each other, definitely has a big potential impact on the institutional investing base. And there's kind of two main areas where that could play out as a result of these proposals, and two areas that I think have general support of the institutional investing community. One has to do with the quality of the NBBO, so that gets to the proposal around tick sizes and access fees. And then the other has to do with the ability to interact with retail order flow, which in today's market structure largely happens to the side. That's not order flow that's interacting with the broader markets. In terms of the tick sizes, like I said, there's broad support for the idea of narrower ticks, particularly in the so-called tick-constrained names. And Nasdaq has written about this at length. There's a significant portion of well-trafficked names that might trade at spreads narrower than a penny if you were able to quote in less than a penny. And that could be up to 15% of the names in the S&P 500, for example. The SEC goes to 4 different levels. I think most market participants think that's too many and too narrow to go all the way down to 1/10 of a penny. But some comments out just this week advocating for half-penny ticks, repeating what was proposed late last year. And I think the industry pushback will just be around simplifying it. In terms of retail and the order competition rule, again, lots of interest in finding a way to interact with retail order flow. However, not a lot of support for the mechanism that's being proposed. Concerns that, one, there could be some adverse impact to spreads as a result of this, and then also the signaling risk associated with just the existence of an auction or the existence of a failed auction, which could lead to a worse experience in those cases, and frankly maybe not liquidity that institutional investors are incredibly eager to interact with.
Is that why we're hearing a lot of public responses from the market makers? As an example, it seems to be, everything that we're just talking about is their bread and butter.
Yeah, of course. I mean, in that case, it's a direct impact to their business model.
Right. So where do we go from here?
Yeah, well, I mean, I think it's pretty clear that the commission intends to act. There is going to be vocal comment from the industry. There will be pushback on a number of these points, but I think it's pretty clear that they view that there's an issue here and are going to do something about it. So ultimately, all of us as market participants are going to have to adapt to whatever gets through the proposals. Whenever we have these conversations, I always think it's worthwhile to step back and assess the market structure that we have. And the reality is that it benefits, there's very high quality for most market participants, especially retail. If you think about the liquidity, the transparency, the operational resilience, and the competitiveness. I mean, whether it's venues and exchanges, whether it's broker-dealers, it is a very robust and competitive market environment that does lead to market-based innovation and incremental improvement. And I think that's served us pretty well over time. So, hopefully, whatever comes of this, we're able to retain what is good about today's market structure in whatever is to come.
I probably should have asked this at the top, but what are they looking to solve here? Explain it to me like, I'm a retail investor. Yeah. I don't understand what the underpinnings of the market is like. What was the issue? Why did they have to create these proposals?
And there's varying degrees of agreement or disagreement with this point, but I think the issue that's being addressed is market quality and I guess availability of prices for retail investors is of primary concern. So when you enter an order with your broker, you see 19 cents on the offer and you're going to buy. Perhaps there is a better price than that, and they'd like to require all market participants to search for that before basically just taking what's there. If you're going to internalize, you can always interact with the public markets, but better pricing.
Right, which is typical for retail trading. Was this because of what happened with AMC and GME and getting orders filled and at the right prices?
I think so, yeah. I think it's just the general idea that here is a market event that occurred that it doesn't look good, it doesn't smell good, something needs to be done, and I think this is the outgrowth of that.
Okay, all right. Appreciate the insight as always, Jack. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.